We came up the day after all the snowfalls. Hello everyone, we are the Whitman College CFA team and we are presenting on ITRON today. Before we get started, I just want to make a quick note that all graphs, valuation models, and charts are our own creation unless cited.
Great, looking at the valuation summary, we give a target recommendation of a hold with a target price of 61.40, which is a negative 0.12% downside from the price on February 24th. We've seen some price drops since then, so it's a little bit higher now. ITRON trades on the NASDAQ under the ticker symbol ITRI. They're in the sector technology and the industry scientific and technical instruments. ITRON is a company that provides products and services for companies to manage resources.
Moving on to their business model, they recently changed their business model from electricity, gas, water, and networks to this new business model with device solutions, which is just standard meters, and network solution, which is smart meters, and outcomes, which is software and services to collect and communicate data from meters. And this hierarchy is ranked by higher growth rate and increasing margin, so that business can focus on sectors that have higher growth rate in the future. And the most recent acquisition of Silver Spring Networks enabled ITRON to join this Internet of Things market. And from both expert and our own analysis, Internet of Things has very huge potential to grow in the future. And this is their revenue distribution. About 60% of their revenue are coming from American market, but it's worth to mention that it's about 40% of their revenue are coming from international market. And from their old business model, electricity is the largest revenue driver.
Now let's move on to the ESG analysis of ITRON. ITRON has been doing great in terms of environmental and social awareness and sustainability. Each year, they publish 2 reports. The first one is regarding their own corporate performance, and the second one is talking about how the industry is doing. They have been doing a very good job in terms of water and energy use efficiency, greenhouse gas emissions reduction, also recycling their waste. On the social aspect, they encourage giving, volunteering, and educational outreach with their employees to raise the awareness of the host communities.
Moving on to their corporate governance, we did the ISS rating, which is Institutional Shareholder Service rating, and got a 2.25 out of 5, which means their corporate governance has no threat to their shareholders. And this is their management team. All of them are very experienced in both management and in the industry. So we believe they are able to lead ITRON to growth in the future.
We start industry overview with the Porter's analysis, which shows that this industry has low substitute threat, high barrier to entry. However, pricing power of players is limited due to intense competition and supplier power.
Here are some pie charts describing the global AMI market. AMI stands for Advanced Metering Infrastructure. As we can see, ITRON's market share dropped from 12% to 8% from 2014 to 16 due to more players in the game. In terms of growth trend, we can see that China has actually been the biggest part of the market. However, the Chinese market is relatively independent due to different standards. Also, North America is also a huge chunk. We can also see that the unit shipment increased from 76 million to 99 million in those 2 years. In addition to that, the developing areas and region can also mean very promising future of growth. In North American market specifically, ITRON has always been a very competitive leader, and its market share reached 22% in 2016.
Jumping into financial analysis for ITRON, here are the profitability indicators that we thought were important to analyze when looking at ITRON. Those indicators are on the left-hand side of the chart, followed by their trailing 9-month, that'll be 2018, and then their 10-year average. 2 we wanted to highlight was the return on assets, which has become stable and growing over the past few years, as well as the profitability margin, which has fallen significantly since 2016. Jumping into liquidity indicators that we also analyzed, the same thing for the chart with the trailing 9-month and 10-year average. We wanted to highlight their net working capital, which has also been growing, and their quality of income ratio, which is steady above 0. A lot of this is because their net revenue makes up a significant portion of their cash flows.
Solvency-wise, with a negative trailing coverage ratio and increasing debt ratios, we can see that ITRON is increasingly depends on debt as a way to finance. And efficiency-wise, the yellow area shows how their cash conversion cycle has been longer than their 10 years average, mostly due to longer collection days and inventory days. So we were able to bring all the indicators together and compare to their competitors. Despite efficiency, Itron underperforming industry average. However, we want to point out that a higher inventory turnover and a lower or negative profit margin might indicate that Itron has some inventory management problem.
Okay, moving into one of the valuation models we chose, the two-stage discounted cash flow model over 5 years. We chose this model because we do not believe Itron's a high growth company, but rather has modest growth until it reaches a terminal growth rate. Here are some of the assumptions we use for our model. So you can see a beta of 1.03 following growth rates, which I'll go into more detail. After-tax cost of debt based off Itron's bond yields, a cost of equity based off the CAPM model, and the WACC of 5.73%, as well as a year zero FCFF of about 77.5 million. Looking at Itron's beta, we compared it to monthly 10-year returns versus the NASDAQ and got 1.03. We calculated many different growth rates, but a lot of them were very volatile, so we ended up using revenue CAGR and revenue's growth rate to create a weighted average growth rate, weighting those 50-50, and then we used the high and the low as well. So here you can see that we chose free cash flow to the firm as a measure of cash flow because Itron's a leveraged company. And you can see it's very volatile over the past 10 years. So we used a 10-year average to create our year zero FCFF. Looking at our overall DCF valuation, you can see here the present value of Itron's equity at the weighted average growth rate, the high growth rate, and the low growth rate. And you can see the present value per each year going into 2022, and then the terminal value as well. And so this model gave us these following target prices at the low, weighted average, and high growth rates of negative 2.66%, 1.64%, and 5.7%. And we ran some sensitivity analysis on the WACC since Itron has been increasing their leverage and it could affect their cost of debt. And we saw that the target price is very sensitive when the WACC changes within this range.
As we mentioned before, because Itron has very volatile growth rate, so we run a Monte Carlo DCF, which we use the same input as two-stage DCF, but we run a randomized probability simulation to get this distribution. And within that, we got a result of weighted average of 14.92% upside from Monte Carlo.
So overall for our DCF, we came up with a DCF price target, weighting the average Monte Carlo, the average single rate DCF, and the low single rate DCF. This gave us a price target of 65.91 with a 7.23% upside since the February 24th price.
We also ran relative valuation and regression analysis on Itron. So here we compared Itron versus competitors' price to earnings, price to book, and price to sales ratios. We then ran regressions using that data, using the beta, expected growth rate, payout ratio, and net margin. This allowed us to figure out which variables were statistically significant for each of the ratios, and from there create equations on the statistically significant variables to create prices. From there, we weighed them all relatively even with price to book at 0.5 and the other at 0.25, getting a valuation price of negative 30% from its current price.
So overall for our valuation, creating our price target using the DCF and the relative valuation, we weighted the DCF 0.6 because we believe their future cash flow is a better idea of what their current value is because the competitors are very variable. And so we came up with a valuation target price of 61.40, which represents a negative 0.12% downside from that February 24th price.
On the risk side, we believe that Itron's largest risk is their financial risk. How impactful the WACC is to their valuation and how sensitive the WACC is to the intense market competition, their already high leverage and potential Fed rate hikes. However, we think that Itron is in the moderate range of risk because they are using some risk mitigators at listed. On the opportunity side, we think factors like rising population with aging infrastructure and energy constraints will push businesses and government to be more efficient when they use energy. So there's guaranteed demand for this industry. Altogether, we recommend a hold for Itron. Despite the concerns, we believe that they already have the plan to adjust these, such as they prioritize deleveraging and they have a lot of restructuring projects to boost efficiency, which reiterates our hold recommendation for Itron. Thank you.
Thank you, guys.
15 seconds to spare. There you go.
What
would cause you guys to change your price target to a buy? Do you think? got down to a certain price level, or you just don't like the business?
Well, we saw the price actually go down to about 53, I believe, yesterday. And that definitely gives us more upside from our valuations. But we think that this is kind of playing into some of the risk that we presented in our PowerPoint. Essentially, these tariffs are having a large effect on Itron. We saw in Q4 earnings that their earnings per share is expected to go down -0.2 based off just tariffs alone, as well as just kind of more efficiency problems, with supply chain issues and such. So we think that if it goes down more, we could see the upside, which would kind of balance out the risks that are currently present.
You think since they did these relatively large acquisitions over the last 18 months, do you think there's a risk that they take a goodwill charge in terms of maybe they overpaid for the businesses, or kind of what's the risk there in terms of them taking some big charge?
Yeah, certainly there is risk that for goodwill impairment. I think that if they're able to capitalize on this strategy moving into smart city, it won't matter so much as long as they're successful in that. But we've seen a lot of growth, not necessarily organic. So we're going to be looking to see if they can really create synergies with their new acquisition to create organic growth. If they just keep acquiring companies and leveraging it up, then that's going to be a negative sign for us.
Did you guys look at what their organic growth has been over the last 10 years?
No, we did not.
For your discounted cash flow analysis, you used a 10-year average of the free cash flow.
Yeah.
As your starting point, as your year zero. Did you consider I guess using? I mean, I know the company doesn't give free cash flow guidance, but they do provide revenue and earnings guidance. Did you consider using a financial model to kind of calculate, forward free cash flow projections based off revenues and expenses and kind of going down and figuring out free cash flow that way? Or I guess why did you choose to use a 10-year average of free cash flow?
Yeah, so we kind of saw over the past 10 years, it's really been up and down. They've had free cash flow to the firm much above our estimate. They've also had it negative. But based off Q4 earnings that were just released for fiscal year 2018, I believe they released guidance on free cash flow of about $50 million.
Okay.
But yeah, we didn't really take into account any other models. We just kind of essentially used the average and then used our growth rate to figure out what it'd be in the future.
Do you know why the free cash flow has been so volatile over the past 10 years?
Yeah, so we believe it's due to the restructuring that Itron's been going through to lower expenses essentially, as well as earlier during the financial crisis, they also had pretty negative free cash flows, which we assume is just due to lower cash flows those years because of the recession.
We talked a lot about companies' leverage and future delevering. Do you have a target for where you believe the company is going to delever to and where they should be?
Yeah, I can talk on this one. So they recently announced that they were deleveraging from 4x to 2x, but this year, the past year, we only saw them deleverage from about 4 to 3.9. So we would like to see them much lower than that.
Do you have a time period for delevering?
What's the time period?
Most of the debt matures by 2026, so we gotta aim for 3 to 5 years for them to deliver.
You mentioned inventory measurement problems, or as based off of looking at a higher inventory turnover. Can you kind of elaborate on that?
Yeah, sure. So supply chain has been an industry-wide problem, and when a higher inventory turnover does not necessarily mean that they are able to push inventory out that fast. It could just be they don't store enough, so that's why inventory goes so fast. And that seems more convincing to us when the profit or the revenue growth is not that strong with that high inventory turnover. Yeah, so yeah, I confirm with the supply chain, the industry-wide supply chain problem. We think that it's convincing to make that statement.
Yeah, and it seems they've been having difficulty getting all the components on time that they need to build their meters and such. And that's kind of been causing them to have low inventory, not because they're just selling a lot, but they're kind of almost restricted by not having these components on time.
Yeah, this almost stems from them recently, or not recently, but previously selling off their factories and outsourcing from there.
I like the fact that you guys included the long-term ROE from a 10-year standpoint, showing that it's negative. That's a pretty compelling case to have some concern or to support your hold rating. But on a separate note, oftentimes, or on this recent call, a company just announced that with the PG&E bankruptcy, that it's potentially a positive for the company going forward. I kind of scratched my head on that one. Did you guys, first of all, did you see that? And then second of all, why would you think one of the primary customers going bankrupt could be a positive catalyst moving forward?
You know, that's a great question. I kind of was like, what does that mean? There wasn't much guidance on that, but we know that I believe it's like top 10 competitors don't make up more than 25% of the revenue, something around there. So we don't feel very concerned that it'll have like a large impact on how much they can sell, but it certainly is a concern. And I don't know how that would benefit them in any way. Maybe a new player could come into that space in those regions and just pick up where PB&G left off. But yeah,
You kind of, I was taking notes, and so I kind of missed the slide where you were looking at how you selected valuation multiples for them. So possibly you guys can click back to that one. And
The inputs
I
and
was
assumptions.
surprised at how low your target was based on valuation multiples. Yeah.
based on the DCF or
No, you had a slide, I think it was past this one.
passes.
Or the relative valuation regression, the next one.
Yeah, here we go. How does this work?
Do you want to touch on that?
Sure. So for this, we found the price to earnings, price to book, and price to sales for all of Itron and its many competitors in the space. We then also, you want to go back on the slide real fast? We then found the beta, expected growth rate, payout ratio, ROE, and net margin, and used them in each of these ratios. This has allowed us to get a data set where we then ran regressions on it. From there, once we had the regressions, we found out which of these variables were statistically significant for each of the ratios, and that allowed us to build an equation to find a valuation price target.
Yeah, so we essentially just like use these different variables from all the different competitors, about 12 that we used, to try to like predict using a regression what the price to earnings, price to book, and price to sales would be based off the industry. And so these were our different targets, and we weighted the regression less in our overall price target compared to DCF, just because of some uncertainty. A lot of the competitors operate in different markets. They have like different parts of the company, so there is some uncertainty. And that's kind of why we weighted it less.
And then did you use like trailing earnings figures or projected earnings figure for the E side and the B? What did you use for earnings, book value, and sales?
Yeah, so we used fiscal year 2017. Yeah, for all and we kept all the variables constant for every company for like the time period.
I guess I'm just, if they're earnings in 2017, what were they? They were over $3 adjusted, right? And it looked like you were using a 27 PE based on that or something along those lines. So, I mean, that would result in a target quite a bit higher than.
They could be using cap.
Yeah. Okay. Yeah. I guess maybe using GAAP earnings.
What do you guys think in terms of geographically? What's their biggest growth opportunity from a geographic standpoint in terms of North America, Southeast Asia? What areas are their biggest growth opportunities?
Okay. We think we saw the global market within US and North American markets pretty strong. From our research from the US Government Energy Administration, DC is the only state that have 100% of AMI advanced metering infrastructure installed. And here we are in Washington State, we have less than 10% of that for residence units. So there's a huge space there for companies like Itron to fill. And like
That's
this-
time. Thank you.
Thank you.
Thank you, guys.